Hello and welcome to the Alt Asset Allocation Podcast. Today's interview is all about raising capital for your company with Patrick Henry. This is not the give me liberty or give me death Patrick Henry. This is a different one. This Patrick is a serial entrepreneur with multiple exits, including Entropic, which he took from pre-revenue all the way through a successful IPO and a $1 billion valuation. His latest company, GroGuru, has raised over $3.8 million in seed funding prior to just wrapping up a massive $2 million raise on Wefunder in a month. This is very impressive. Patrick was previously an equity crowdfunding skeptic and shares his tips for companies looking to raise capital and secrets for running a successful equity crowdfunding campaign. Before you listen, please don't forget to like or subscribe to the podcast, or even better, leave a review. This really helps more people find this podcast and keeps this thing going. It really, really helps. Please enjoy this episode with Patrick Henry about all things equity crowdfunding. Patrick, welcome to the Alta Asset Allocation Podcast. Excited to have you on today.
Well, thanks for having me on. Really appreciate it.
I'm excited about this conversation, and I'll link all of these things in the show notes, but you wrote a fantastic piece about the 7 secret ingredients to a successful equity crowdfunding campaign. So you just finished up on Wefunder. You raised $2 million. I was introduced to you as previously a crowdfunding skeptic and now a believer. So I was really excited to have this conversation and have you share a little bit about what you've learned thus far. I wanted to start off today just with a little bit of your background, who you are, some of your experience with raising funds, and start with that.
Sure. Yeah. So I'm a serial entrepreneur. This is my GroGuru is my current company, GroGuru, and we're really all about strategic irrigation management. We help commercial farmers make more money by increasing their crop yield and more efficiently using water and other scarce resources in a more sustainable way. But this is my 4th tech company running over the last, 20 years. 11 of those were with a company that I joined in 2003. We took it public in 2007, and then I ran it as a public company for 7 years. So kind of took it from pre-product, pre-revenue to an IPO, and then eventually a $1 billion valuation. And we sold that company in 2014. I had a couple of other prior exits. But after selling that company, I needed to kind of detox from being a public company CEO for 7 years. So I started, saying on some boards of directors, doing strategic advisory. I was doing a lot of blogging. Then eventually I wrote a book called Plan, Commit, Win, 90 Days to Creating a Fundable Startup. And that was really based on my experience raising a lot of private and public money. I've raised over $200 million for my companies in both the public markets as well as through venture capital. And when I got into GroGuru, not only has the market environment changed relative to venture capital, and we can talk about how that's changed, but in a summary, they've kind of moved downstream. They're doing more bigger deals, later stage deals, but also it's just the whole landscape in terms of angel investing. That was something that I wasn't as familiar with. I was typically brought in, as the adult supervision, hired gun management person in these companies. And this company, I came in way earlier. I was found pretty early in the life of the company. So we weren't really at a place where we were ready to raise venture capital. So we raised a lot of angel money, which is a totally different experience than raising venture capital. And then, we got an opportunity to look at Wefunder, and turned out to be a huge success for us. As I guess, like you said, as a skeptic going in, and I don't know if I'm an advocate, but I'm definitely a very pro equity crowdfunding person at this stage, and it's been a great experience.
Yeah, there's a ton of things I want to dive into there, but just for my listeners, typical crowdfunding campaign in 2019 raised an average of $260,000. Typical raise on Wefunder is 300 to 350K. Typically that takes 60 to 90 days. You with GroGuru blew this out of the water with $2 million in 35 days. So just, firstly, congrats, fantastic job.
Thank you.
These are amazing, amazing numbers. So before we get into that, I think it might be helpful to talk because you're so experienced with raising funds from angels for venture and all public markets. I mean, these are very, very different things. So could you talk about the difference a little bit and some of the things you've learned from raising capital through these different avenues?
Yeah, so a lot of it really, I mean, even before that, what kind of company do you have? Do you have a company that you even want to raise outside money? If you've got more of a small to mid-sized business, sole proprietorship, you may never want to raise outside capital, or if you do, maybe you do a loan with somebody or have one partner that comes in as kind of the financial partner. But you typically don't want to raise venture capital because the goal of those companies is to basically get to cash flow positive as quickly as possible, and then basically pay yourself through the money that you're making with the business. I've always been involved in more of these potential hyper growth businesses where you're looking at big markets, and yeah, it takes more money, so you basically go negative before you go positive. In fact, a lot of these companies are still negative even when they go public, which is shocking. But basically, in order to raise millions of dollars, most of us don't have that kind of money, cash on hand. So you have to go to the outside markets to get capital. And in kind of the very early stages of a company like that, you typically bootstrap it. It's yourself, your co-founders, maybe some friends and family, and then you high net worth individuals that basically think you're cool and like you and think your idea is cool and they like that, and they're willing to make those early investments. The one of the most notable angel investors is like a guy like Peter Thiel, who he's made a bunch of different investments that have been super successful, but he was an entrepreneur that then became an investor. And then eventually, you raise venture capital when you want kind of the millions of dollar check sizes. So typically, in the bootstrapping mode, depends on how much money you have. Maybe that's the first $100,000, $150,000, and then with high net worth individuals, there's the U.S. Securities and Exchange Commission. They've got a method for raising money from what's called accredited investors, called a Regulation D financing, and there's like all sorts of subsets of that. But basically, you have to be an accredited money. You have a big salary between you and your spouse. And typical check sizes in those types of situations are, $25,000, $50,000. Every once in a while, maybe you take a $10,000 check. Maybe you got somebody that writes a big check, like $100,000, $250,000 check. But that's the kind of money that you're raising in angel investing. And that requires you to have a network of high net worth individuals that you can tap into. And either you have that on your own or through friends that may know people, you kind of connect people that way. Because of my experience, I've got a pretty broad network, and I've also been involved with some accelerator programs where I've gotten, warm introductions to angels, to raise that money. So prior to Wefunder with GroGuru, we raised a total of $3.8 million in what I call angel money. So this is between individuals, family offices, angel groups, and accelerator programs. So that's kind of how much money we raised prior to the Wefunder. Then the Wefunder, I was thinking we wanted to do a venture round, and then when COVID hit and things really tightened up with venture capital, I'm like, oh, guess we got to figure out another solution here.
Yeah, the venture money wasn't exactly plentiful in the March timeframe, right?
Yeah,
Like,
I mean, what really happened was, and this happens in any kind of recessionary environment, and I've been through, I guess, 3 or 4 of them at this stage of my career. Was with venture capital, when that happens, they kind of batten down the hatches and say, okay, how much money do my existing companies need? First off, I got to triage my existing portfolio. Which ones do we like? And then the ones we continue to finance, how much capital do they need to weather the storm? And typically I'm thinking, okay, this is going to last 12 to 24, maybe even longer than that, 12 to 24 months, maybe longer than that. So that process may take a few months. And we were in conversations with venture capitalists back in the January, February timeframe, and we had half a dozen that were pretty interested in us. And then boom, we just hit the wall. And our business was doing great. The business was continuing to grow, and even with COVID, we continued to grow revenue at a slower pace. So we're not recession proof, but we're recession resilient. So farmers continue to farm. We sell into the agriculture industry, and farming's always hard. So this is another hard year.
Having experience raising from all these different methods, managing the different investors based on where they come in. I like the initial like seed round is FFF, friends, family, and fools, right? It's
Yeah,
like those initial checks. I mean, it, if you raise 3.8 million, a lot of these like $25,000 checks. I think in your article you mentioned like it was dialing for dollars, just
yeah.
like a very inefficient process. So where were you going for these? You mentioned angel networks, accelerators, like family offices. What was kind of the best source? And obviously, this depends on the type of business that you have. But for
Sure.
you, what seemed to work the best here?
Yeah, I mean, I'm fortunate because I'm not a first-time entrepreneur, first-time founder. I have a track record of success of building businesses and building companies. So through that process, you get to know other CEOs, you get to know other angel investors and other successful people, and you kind of mine that network. And I think it used to be you had to kind of scrape the Reg D filings, they call it, go to a Mattermark or Crunchbase and do all that kind of stuff. And it's still a good way to do it, but then you're kind of looking for a way to get a warm introduction to those people. And one of our the guy who's the CEO of one of the accelerator programs we're in called Evo Nexus, his name is Rory Moore, and he's also on our board of directors now. But Rory was really well connected in the angel community in San Diego, and even kind of more broadly in Southern California and things like that. Once you find an angel that is interested, sometimes it's like mining for gold. You hit a vein of gold, you're like, okay, who do you know that might also be interested in putting money into our deal? So there are probably, if you kind of look at the lineage of how money came in, there's probably half a dozen, maybe 8 investors that we also had additional investors through those people. So like, oh yeah, call my buddy in New York that does this kind of stuff, and I think he'll be excited about your deal. So those kinds of things. But eventually, like a vein of gold or a vein of silver, you're tapped out. So we're at the stage, in early this year where, we got a couple of them. They're like, hey, we'll put a little bit more money in to kind of prime the pump for this next round, but you need to find some new money. And it's just one of those things where when your network is exhausted, then you got to find something new.
Yeah, and I would imagine it's a bit of social proof, right? Like getting that first check or those first couple checks really gets that snowball, that momentum. As soon as other investors see that other people have invested, it suddenly, it becomes a little less risky because, somebody else did due diligence. Like you being a multiple time founder definitely helps, right, with that track record. But I think that's very
especially
important.
if these people are considered smart money. If they're smart money
Exactly.
investors, either they have a lot of technical expertise or domain expertise. Like we've got guys that are former CEOs of big real estate development companies that also have a farming background. Guys that have run big tech companies. Some pretty big early stage investor groups like Mentors Fund, Right Side Capital, Longley Capital. Basically, people have more confidence around them than like if it's my brother-in-law.
Right. Yeah, exactly. It gives that stamp of approval of somebody that knows what they're talking about with this
Right.
business. So I do a fair bit of startup advising, and a lot of these people are really struggling early on, limited resources, they're bootstrapping, but they're hearing a lot of these success stories. Obviously, it's survivorship bias of all of these companies, all of this cheap money out here. It's so easy to raise capital. Why don't we scale back on launching this bootstrapped business and getting traction and just focus 100% on raising funds? I mean, what advice would you give people in this situation, or how to think through it? Because obviously, as soon as you raise funding, it completely changes the dynamics of the company. You no longer can call all the shots without anybody asking any questions, right?
I mean, I kind of think of it the reverse of that, and you're in a little bit of a delay there. So, but basically, shut down the business to raise money. That may work if you have a significant track record of innovation. Like in my last company, Entropic Communications, the lead founder had a prior deal that he was involved with a major venture capitalist up in Silicon Valley. And when Itzhak, is his name, Itzhak Garance, decided he was going to start a new company, John Malechka from Redpoint just wrote him a check for $1 million. And said, okay, I'll just roll this into my Series A when we do that, but use that to kind of figure out what you're doing. Most of us don't have that luxury. The investors want to see some kind of proof points. And that's where, you get into things like lean startup, where it's like, okay, get to a minimum viable product. And especially if it's something where you can test it without building the whole product, or test it on the internet and do those kinds of things and get some real customer feedback that's validating around the idea, that will allow you to raise both more money, but also more money under better terms. So, like I said, most of us aren't the Itzhak Grants, type of people. So we have to do it by trying to build a business and establish some sort of traction, even if it's just early traction and early feedback around things, because that's more validating around your idea versus just kind of two people in a garage, with an idea and a dog. It's kind of those are hard businesses to fund. But a lot of them start that way, like Hewlett Packard and Apple Computer. But those guys, they got something working, and then they got people interested because they had something that was relatively interesting.
Yeah, the ideas are cheap, right? And I think the important thing here always is that traction is very subjective. So traction can just be, number of signups. You put a splash page and like drive some traffic to it, and people
Yeah.
are signing up. So that is considered traction by some investors, and it's so much better than just a pitch deck and a wild idea.
Yeah. And people also invest in teams. They invest in people. So I remember, I think it was the guy that started Dropbox. He was applying at Y Combinator, and he didn't have his technical co-lead, and they said, come back when you have your technical co-lead. So he went out and explored, and found a guy at MIT that he ended up working with, because I wrote an article on this, I think, in Entrepreneur Magazine, and I think it's like, what makes startups successful and why do most startups fail? And a big part of it is having the right mix of people on the team, that the founding team that can really kind of make the business go forward. And there's a business component and a technical component. And sometimes that exists in the same person, but typically it's two kind of co-founders that bring both of those pieces to the table. So it's a combination of that. If you don't have a track record, not the end of the world, but at least have something where you have some credentials that you bring to the table. And then, like you said, traction means different things to different people. Some people, it's like, if you don't have, $1 million or $10 million of recurring revenue, that's not traction. But other people, might be like, I got 10 signups on my website.
Yeah,
I don't know.
exactly. They're all forms of traction, right?
Exactly.
Differing levels of risk appetite, I guess, from the investor's perspective. The other important thing with startups that blows me away is timing, right? Like all these crazy 1999 internet ideas probably are great businesses now. Like I haven't checked like pets.com, things like that, but these all work, right? They were just a little early and overhyped at the time. The plan for GroGuru was to do a venture round, continue to raise from private funding, not go crowdfunding. Your decision changed. So this was partially a byproduct of COVID-induced recession, I guess. How was Wefunder pitched to you in the beginning? Like,
Yeah. So I'm fortunate. When I wrote my book, I did a Kickstarter. So there's pre-sales crowdfunding, which is like Indiegogo and Kickstarter. So I was kind of familiar with it. I was familiar with equity crowdfunding. The Jobs Act, came out in 2012. Part of what I did in my consulting business, advisory business, was talk about that. Regulation 8+, Regulation CF. regulation crowdfunding being two additional ways that startups could raise money. So I had a little bit of a framework around it and done a little bit of research around it. So, but the good news is you have the internet. So you don't have to go to the public library. You just go on the internet and figure out what stuff is and read different articles and things like that. But the thing that I learned in our Kickstarter, both from my research and then so much of it is about early momentum, getting to the top of page one, getting that visibility. So first off, being on a platform, there's going to be a lot of eyeballs on and the most relevant eyeballs. But then secondarily, being at the top, so those eyeballs can just turn on the page and they see you. So in the early days of equity crowdfunding, it was more about, call it business to consumer businesses, where you're trying to build a tribe and an advocacy group. And I think there's still a lot of that today where, your customers are also able to become investors. And we're not really a traditional B2C type of company. We're not a traditional B2B company either because we sell to farmers. So they're consumers, that we sell to end users, but they're kind of buried in the supply chain and the food chain. So I didn't really think that in the beginning this would be relevant, and would a retail investor really be able to wrap their mind around this if they're not a customer of our product? So that was kind of my initial first level of skepticism around equity crowdfunding. And then the other piece was, you can't really raise much money. You in the world of venture investing, they really want you to focus on keeping what they call a clean cap table. So this is basically, for the people that don't know what a cap table is, your capitalization table. You don't want like thousands of individual people on there. You want, Peter Thiel and, the guy that used to run this company, the guy that used to run this company, and, basically have, I don't know, 30 to 50 investors at the most. And in an equity crowdfunding, with the check sizes are so small, it's like you're going to have hundreds, if not thousands of investors. And that just doesn't work if you eventually want to raise subsequent rounds of financing from venture capital. So my contact at Wefunder, I met him through the San Diego Angel Conference. He's an angel investor. He also is on the Wefunder team. He was involved in our due diligence committee. We won the People's Choice Award at the Angel Conference. So there was some level of understanding with the general community on our messaging, on what we do. So we were able to get it dialed in enough that our value proposition, the market, was digestible by the typical investor, somebody that didn't have to be like a crop scientist or an engineer. So I think that was one positive. So B2C wasn't necessarily necessary, and there had been other companies over the last couple of years that were more B2B companies that were having some success on these crowdfunding platforms. Now, the second thing is people raising more money. Like you said, the averages are 300 to 350, but there were companies that were raising $1 million, $2 million. So that was kind of interesting. And then they recently implemented a new model where they have a lead investor. So there's a Regulation D platform called Angels List. And on Angels List, the best way to raise money is identifying a syndicate lead. So somebody that basically is the lead investor. They do the due diligence. They put the investment group together and then make the investment. So it's a single line item on the cap table instead of, all the individual investors, and that single investor has the voting rights and those kinds of things. So they've kind of, at Wefunder, they've adopted that model where you have a lead investor, or you can. And that's something that was of a lot of interest to us, and that was kind of an essential component for us to be able to move forward with them. And we ended up having a great lead investor, and that's part of the reason why we had such a successful campaign.
Yeah, that makes a lot of sense. I mean, those are very common objections, I would think, and the fact that you just blew them all out of the water is pretty amazing. So let's just jump right into it. I mean, you have this great blog post that I'll link to, but I mean, the 7 secret ingredients. It's very very good title. I don't know if you tested those, but it certainly interested me. So if you were talking to somebody that's interested in crowdfunding for the first time, like obviously you've talked about some of your objections and how those didn't end up being that big of objections or you blew right through them. But, what are these 7 secret ingredients? Walk me through what you learned and what people need to do to have successful raises on crowdfunding platforms.
Yeah, I mean, it's in investing, a lot of it, these things are common, but equity crowdfunding is a little bit different because you're pitching to retail investors. So first thing, if you're, and this is something I talk a little bit about in Plan, Commit, Win, is that a fundable startup, they've got, a big market opportunity that has potentially explosive growth, a really differentiated product that solves a major problem in the market. So they've got a great solution for a real problem. And there's tons of problems, but not all problems are problems that customers want to solve because it's not painful enough. So it's got to be really painful for your target customers. And then you can sustain a competitive advantage over time. And then you've got a great team. So I think those elements, regardless of if you're bootstrapping or you're raising angel money or you're raising equity crowdfunding, or even if you're raising money in the public markets, those are essential components of having a fundable company. Unless you're kind of like in a real mature business, then there's a whole set of different metrics you look at there. But growth companies, primarily startups, that's really important.
So those 4 was to be a fundable company, lots of potential. You're solving a major problem, bleeding neck, super painful problem for the customer. Team and sustain that competitive advantage over time.
Yeah,
right?
Big market, growing fast. But like you said, there's a timing element of it. In a startup, you don't want to be late, but you also don't want to be too early. So you want to be early, but just early enough. You don't want to be at the party 3 hours early. You want to be at the party 15 minutes early. You don't want to be there half an hour after there's a big crowd there. So that's kind of, that timing element is important because you got to intersect the market. And that's a whole other topic we could talk about at some point, but timing the market at the right time. And a lot of that deals with the ecosystem. Is the ecosystem mature enough that the thing can ignite, the thing can accelerate at a very rapid rate? So if you're doing a streaming video service to the home, if you don't have broadband internet and significant capacity on broadband internet, it's not going to be a successful product, even though people might actually like the service. It doesn't matter. So there's things that have to be in place for a market to ignite. And your market all markets are different, but those kind of key ingredients have to be there. So that, I don't know if I talked about that in the blog post, but that's kind of the fundamental of do I even have a fundable company? And then within equity crowdfunding, I think that, I don't remember the 7 ingredients, but I can probably look it up, but you can also look it up. I think the big things in my mind, we talked about momentum. I mean, I think that was number 7, but it's really probably the most important is you got to have that momentum. But how do you create that momentum? And in our case, we had a lot of early interest. We did our marketing correctly. We put a killer video together. So having the feature video on an equity crowdfunding, that 3-minute video where you give your elevator pitch, you give social proof around your concept, that's critically important. Real clean, easy to navigate homepage, again, with a lot of social proof. We had investor videos on there. We had some customer videos on there. Then basically having that commitment to stay with it the entire time. What I like to say is there's 4 main jobs you have as a CEO of a startup. You're the head of human resources, so you got to hire the team and keep them motivated. You're the head of operations, so all the building the product, all those kinds of things. Head of finance, making sure that the cash is managed properly. And then you're the chief salesperson, so even because you're not only selling to customers, you're selling to your employees, you're selling to your other stakeholders, your investors, your ecosystem partners, all of those people. But in that finance piece of it, the fuel that makes a startup go is cash. So if you don't keep enough gas in the gas tank, you're failing as a startup CEO. So with that in mind, this fundraising component, it's a big part of your job. So if you're going to be doing a Wefunder campaign or raising a financing round, you got to dedicate a certain percentage of your time every day to doing that activity, and regardless of all the interruptions and everything else. So we were very active in terms of posting updates, answering questions, doing these kinds of, podcasts and interviews with people, interested stakeholders. So there's a lot of that stuff that needs to happen as well. And that keeps the visibility up. So getting that early momentum, a great team around you, all the marketing components, and then kind of keeping the momentum up once you get out.
Yeah, I think that early momentum, that search engine optimization on Wefunder and figuring out what it is they're valuing and really hammering that. So like you said, every time everybody opens that website, they see you right away. And then you talked a lot about the video. So, the short 3 minutes, you talked a lot about social proof. Was this something you had done with the Kickstarter campaign, having something like this, or is this all new concepts that you've been thinking through with GroGuru?
Yeah, I mean, the feature video is important in any kind of crowdfunding because it's you've got the short attention span theater that exists out there, and that exists with venture capitalists as well. If you're in a venture capital meeting and you don't have their interest in the first 5 minutes, the meeting's over. I mean, it may continue, but the meeting is over. So you've got to grab that interest because it's not, when you're doing equity crowdfunding, it's online, it's not face to face. The way that you pull people in is, first off, you have other investors that are credible, so lead investors, very helpful and important. You're getting early momentum, so there's a lot of money coming into the deal. So it's like there's a herd mentality. I want to invest in the hot deals. And then there's that being able to describe and get people excited in a very short period of time, ideally in a minute, the elevator pitch, but sometimes to kind of get the whole story out and get some customer testimonials in there takes a little bit longer. But if you're kind of over 3.5 minutes, if you got like a 5 or 6 minute video, forget about it. Unless it's something that's super technical and you're in a very technical audience or that kind of thing, you really got to make it pop. And one thing we didn't talk about, probably one of the other 7 secret ingredients, but is that even if you do all that and you're not on the right platform, you're going to have a problem. So in the case of Wefunder, they're not a vertical platform. They're not just in the farming agriculture industry, but they're a big horizontal platform. They've got a lot of investors that come to their site, so that there's leverage in doing that. So if you look at even Kickstarter and Indiegogo, I mean, Kickstarter I think is better for books and better for consumer products, where Indiegogo, if you're doing an independent film, you probably have more people investing in independent films on Indiegogo than you do on Kickstarter. So doing your research and saying, okay, I'm going to be on the right platform at the right relevant audience, because that's getting the video out there. If it's something that, somebody likes comedies and you're doing a romance, it's not necessarily going to match up.
Yeah, but I mean, like you said, like most of these things, you look at them and you're like, oh, B2C, I get it. Like these people, they can see themselves using it, so they want to invest in it. Like I get it, but like, I mean, ag tech, I guess as an end consumer, right? I love to eat anyways. So I guess
sure.
At a derivative, I am a consumer ultimately. But I think I'm one of the few people that gets really excited about ag tech. I've had a couple farmland investing crowdfunding platforms on the podcast, and it's a really, really interesting space.
But that gets to the point of like making the message relevant for the audience.
Exactly.
Now, if we say, we sell soil moisture sensors, and they measure, soil moisture and temperature, and they'll help, with growing corn and those kinds of things, that's not really going to play. But if you say, hey, we help farmers. I mean, everybody knows, hopefully, especially after COVID, and they go and see empty shelves at the store, there's nothing more strategically important than the security of our food supply chain and fresh water.
Yeah.
So those are 2 big things. There's a lot of issues around climate. So there's nothing really more important than sustainability. So, I mean, we're doing all 3 of those things. We're helping save water. So those are kind of touch points that a broader set of investors can resonate with, that if you kind of pigeonhole yourself too narrow, you might not bring all those other potential investors in, because there's more and more people doing impact investing, investing in things that are around sustainability and around improving the planet and, leaving the planet a better place than was where we found it. So those, and it's got to be honest, you can't just BS your way through this stuff, but if you really have things that you do that are valuable to an audience, you should highlight those things. And it's more about the what you do and the big picture vision, and then you can get into the how a little bit, but it's more about those things. So that's in the messaging that becomes really, really important.
Right. And how important is simplicity in this messaging? I mean, you talk about a lot about the why and being transparent and all of these things, but how important is just communicating that in very simple, easy to understand terms?
It's knowing your audience. If I'm going to be speaking to a 30-year-old hedge fund guy on Wall Street that's a generalist, even that's different than the same demographic that's a specialist, that they really understand TV and communications or ag tech or whatever. If I'm talking to more of a general audience that isn't technical, then communicating in a language that is understandable is really important. You don't use 3-letter acronyms. Don't use a lot of technical language. Don't do a lot of those kinds of things. And then making it crisp. People got to get it. They just don't have the patience to listen to this long diatribe and why it's important and why it's going to be successful in a relatively short period of time. I'm talking a few minutes.
Yeah, very, very short and getting shorter, right? Two other points that you had mentioned on here, I think engaging your network, which I found interesting that you said, you personally use in priority order, LinkedIn, Twitter, then Facebook, very little Instagram. So I think obviously this varies based on your business, but I found that very interesting. My LinkedIn is kind of a disaster at this moment. I mean, I think the prevalence of these automated outreach tools have just filled up my inbox with spam, and it's good to know that LinkedIn is still providing a lot of value. I mean, it should, right? That's a professional network. But did you have most success with generating interest in investing on Wefunder, or just on what you guys are doing? Like, how'd you use this platform most effectively?
Yeah, so I'm not doing a ton of direct mail outreach, and because of the issues that you mentioned, I don't think it's incredibly effective unless it's kind of law of large numbers and you're just kind of going to get a small percentage, which isn't, I don't have the time or the wherewithal to do that. So leveraging and engaging your network. I mean, I've got a group of people that follow me, and follow me on LinkedIn. A typical post that I put up might get, I don't know, 2,000-3,000 views. A good post might get 5,000 or 6,000 views. And then a tremendous post, I've got one up right now that's about an investment group that put money into us early on. That's got like 9,000 views. So part of it is keeping people updated on what you're doing and then igniting that network. It's like, hey, you might have friends that are angel investors that didn't want to put $25,000 into this company. Now's your chance. You can put in as low as $100. In fact, they don't have to be accredited investors. So and these are people that have either invested in us or maybe they haven't. I've got some people that hadn't invested, and they might have written a $10,000 check or a $5,000 check, and just, hey, this is an opportunity. I'm not trying to twist your arm. I'm saying, hey, we're going to be successful regardless. But I'm invested in this. I've got my money in it. I've got 3 years of sweat equity in this thing. It's really taking off. This is an opportunity for you to come in. So it's really about using social media as kind of an amplifier on the messages that you're already sending. Now, our marketing firm also ran Facebook ads, and I'm not, a Facebook ad person. That's a specialty to do that, but they created the ads, they ran the ads. I think they drove a lot of traffic to Wefunder that way, but that wasn't my network. My network is mainly my professional network. And I've got a large following on Twitter because I had my own kind of consulting business and wrote a book and blogged and all that kind of thing. So that's more like short attention span theater. I mean, I think the half-life on a tweet's probably like 20 minutes. So, I wasn't posting frequently enough that I was really leveraging Twitter, because you got to be posting like all the time on Twitter to kind of get things going. But at least, hey, it's out there. I'll post something on there. But the real focus was on, okay, on LinkedIn, here's what's going on. Then the other thing was doing some outreach within my network and saying, hey, okay, I've got 75 investors in my company today. This is pre Wefunder. Here's a post that I did on LinkedIn, because every time you do one of those activities, it gives that post more juice. So that's something that's really important. Every time somebody comments on a post on LinkedIn, it goes back to the top of the feed. So, commenting is about 10 times more powerful than just liking it. So if somebody takes time to write a comment, that gives it a lot more juice. And if they share it, it amplifies it, because it's going out to a much bigger audience. So I would send out a note to my investors and say, hey, here's a post, do this. Here's some stuff we're doing, do this. And, I would get a decent number of people that would do that, which I think, again, gets the message out there. I don't know how much traffic we drove in. I haven't looked at the analytics from that standpoint. But getting your network engaged and excited about what you're doing, I think is really important. Sometimes they write a check, sometimes their friends write a check.
Right. The reach on these things is just extraordinary. So definitely tapping into it makes a lot of sense. I wanted to shift a little bit. Number 6 on your list was listen to the market and talk briefly about valuation. So I didn't see at what valuation you raised, but in this, it said you adjusted the valuation cap and early bird program based on feedback. So talk to me a little bit about valuations you used for GroGuru, how you thought through this, and where you ended up settling.
Yeah, so we still haven't raised a priced round. So we still haven't raised money in stock, preferred stock. All the money that we've raised is in what's called safe agreements, which are kind of like a convertible note without an interest rate, and then 2 convertible notes. So on Wefunder, which is another great thing about Wefunder, you can't just raise preferred stock. You could raise money on a safe or a convertible note. But what you do have in the convertible note is a valuation cap. It's not, setting a price on the company, but it's basically letting those people make more money, if you go through that valuation cap. So there's a discount to whatever the price round is, but you get a little sweetener by setting a valuation cap. And some people get way too wrapped around the axle on it, but that's another story. So I think what we did is we had raised money before, and we've continued to raise our valuation cap as we've moved through successive financing rounds. But my thought was, hey, I'd like to do this at a $9 to $10 million valuation cap. You still get a 20% discount. So even if you raise money at 8 million, they're going to get a 20% discount off of that. But some people like it's important, and it's like, how do you get the audience engaged? So I had a conversation with our prospective lead investor, Startup Camp, and they ended up being our lead investor. And he was a lot more comfortable with $8.5 million and giving an early bird discount on the $600,000 of the raise, where a lot of his investors come in, of 7.5. So I'm like, I can do that. Our previous was a $6 million cap, so it's still a step up. I think both founders, CEOs, startup CEOs, and investors sometimes get their mind wrapped too much around valuation, and these are all just intermediate price points. They're not the only time that it really matters around valuation is the exit. And you do want to be concerned about your percentage ownership, and investors should be thinking about that as well, especially if they're a big lead investor or a big venture capitalist, is, how much of the company do I own? Because I'm putting a big amount of my time into it. And like, me and my co-founders, we're putting a lot of time into this too. So we want to make sure that we have enough of the piece of the action, because we're not making money on salary. I mean, it's a joke. So we're making money on, if this thing is successful, we want there to be a big payout associated with that. And that's about how much do you own of the company when you get out here to the exit. So yeah, it was a pretty easy decision. We had a discussion around it. I could have just dug my heels in and said, no, this is what it's going to be. And it might have been the same outcome, might have not been the same outcome. But I think part of it's also the psychology of what's going on there. they want, you want to work with people that are willing to work with you, and showing that little bit of flexibility won't make, a hill of beans difference in the overall outcome of our company, but it made the lead investor feel really good. And I think they got more excited about it, put more money in.
Yeah, definitely. I I'm curious. So your goal for Wefunder was much lower than $2 million. Like this was oversubscribed or like a very spectacular finish. So raising more than you had initially planned, like what does this change in terms of roadmap? What does it change for or GroGuru going forward now that you have a little bit of extra capital?
Yeah, I mean, we were thinking about it as kind of a bridge round to get to the next round of venture capital, which it still is, but it's a much longer bridge now. And that allows us to be a lot more strategic, and set the milestones we can accomplish at a much higher level when we do this next financing round. So I think we took a little bit more dilution, by raising some money at kind of this lower valuation cap, but it just gives us a lot more flexibility to lean forward a little bit more, even in an environment where, you got to really be careful. I mean, we're still in a recession, but we can be a little bit more strategic. We can, accelerate a little bit of stuff from a product development standpoint, accelerate a little bit of stuff from some hiring of some key salespeople that we probably wouldn't have hired otherwise because we've been really protective on our cash. So the reason why you do that is because you think you can accelerate revenue. If I hire a salesperson and they don't, generate 5 times the amount I'm paying them, that wasn't a very good hire. So it's really about achieving more and giving ourselves a little bit more breathing room and a little bit more time before we go out for the next financing round.
Yeah, and ultimately building up a higher valuation for this next round, right? Further
Exactly.
down the road.
Exactly.
Great. What's next for GroGuru? I mean, your roadmap, what excites you most about the near term and longer term?
Yeah, I mean, I think those earmarks of what makes a fundable company is really the same thing as makes a successful company. I think we're timing the market correctly. The ecosystem pieces are in place. We have a potentially massive market opportunity. We're early enough. We're in the early innings of the first or second inning of a ball game, a baseball game. So we're early. Big opportunity in front of us in terms of market growth. We're gaining market share. We're the technology leader, and we're going to continue to accelerate our technology lead, which I think ultimately leads to market share leadership. And farmers love what we're doing, and we basically have established what venture capitalists and all of us kind of in this startup jargon world, product market fit. So we've established product market. This is something that I'm buying, and I'm going to buy a lot more of it. So that's a big deal. So now it's a matter of how do we put more gas in the engine around the customer facing side of it. Well, obviously, we're still doing some product development because we don't want to be a fixed target where somebody comes in and just hammers us. We're continuing to do even more cool things than we're doing right now that helps farmers even more. But having that initial product market fit and getting that, we're starting to see kind of the big deals come in. So you start and you get the tens of deals, then you get like the hundreds of deals. Now we're like getting big chunks. I mean, we have 4 or 5 opportunities that are in kind of the 1,000 plus, range, which that's super exciting. That's like, okay, this is becoming a real business. And and I'm very fortunate. I work with an amazing team. So there's no, a lot of companies, when you're dealing with a group of founders, what I like to say is, if you want to start a revolution, sometimes you need some anarchists. But anarchists, by their nature, are like, they hate authority. They hate, they pretty much hate everything. They hate themselves. They hate their lives. So I'm dealing with a set of people that still have that innovation, but they're good citizens. It's like we're trying to build something together, and the competition isn't each other. The competition is out there, and we feel like, hey, we can crush the competition because we have something that not only we believe it's awesome, but our customers feel like it's awesome.
Awesome. No, I love it. And I mean, the end goal with GroGuru, like you've taken other companies public. So is IPO, is this the end game as of right now? Obviously that changes maybe.
Yeah, I think that if you look at startups in general, with the vast majority of fail. So I think we're going to be on the positive side of that and have a successful company. I think we're building a real business, and there's a lot of market validation around it. But most companies, of the ones that are successful, 80% of them get sold, and to a strategic acquirer. So basically, that's the most likely outcome for the company. But then there's that 20% where maybe we end up being an industry consolidator. We raise some money from private equity and start rolling up this part of the business. Or maybe, it does grow so fast that you do take the company public. The thing with taking a company public is that's not an exit for the founding team or for management. That's an exit for your outside investors. And I remember at Entropic, I'd been there 10 years, and I eventually, it's like, hey, I've been making almost no money, and I took 20. It's not like I took 80% off the table. It's like I took 20% off the table, and people freaked out. So when you sell the company, it's more of an exit for the founders. Now, as a good steward of the investors, you have to say, okay, I want to do what's best for the entire shareholder base. So in the case of Entropic, the primary potential acquirer of the company, a company called Broadcom, always wanted last year's price. So we can never get a deal done with them because they always wanted to significantly undervalue us, not a little bit, significantly undervalue us. So we're like, hey, we can make 5x this by taking the company public. Now, we had to go through the Great Recession, and, we took the company public at the end of 2007, and it was a good exit, but the next
Some tough years in there.
all the customers converted. We took it to $1 billion valuation. It was, it worked out for everybody. Some more than others, but it worked out for everybody. So it's one of those things where you've got to decide how much additional risk are you willing to take on. And every time you go out for a new funding event, you have to kind of look at it and say, okay, I'm going to raise another $5 million or another $10 million. What can I accomplish with that money, and how much risk is associated with that? And am I better off selling now or doubling down and taking it to the next level? And these are things that as a board of directors, as a CEO, you need to be thinking about and saying, okay, and then influencing people along the right direction, and not in a selfish standpoint, but what's best for the entire investment group. Does that make sense?
Yeah, it does. And I mean, each time you're raising additional capital, you're bringing on additional investors that have different priorities and all of these things, right? So
and
it's
different return expectations.
Exactly, and timeline for them
Yeah.
too, right?
Yeah.
So it's I applaud you after going through what you did, multi-billion-dollar valuation and exit, and then starting over at ground zero and doing it again. So,
and it's kind of, I remember I was watching, I guess it's the Grammys, the music awards, and this was a number of years ago, and Coldplay got the best new artist award, and best new group or something like that. It's like, yeah, it only took us 10 years to become best new group, because everybody just sees
10-year overnight success, right?
Yeah, they don't see all the ridiculous stuff that you have to go through. Primarily entrepreneurs, just realize, even for somebody that's had a degree of success, like me, this stuff is hard. I mean, it's really, really hard. I mean, it's hard to raise money. I've never been one of those guys that's been able to just show up and get a check. I've heard those stories. I've never personally experienced that. This is a grind, and you have to grind it out every single day and work for every dollar. And you're going to have times when you're depressed, and times when people don't believe in you and think you're completely full of it. And you've got to have that vision and belief to kind of make it through that. And if you surround yourself with a good team and you're on the right track, and that eventually people will come around, then stick with it. I've got this real pet peeve around, failing fast. A number of things wrong with it from my perspective. First one, it starts with failing. So it's like, don't plan to fail fast. Don't plan to fail at all. You got to plan for success. If you're going to go into the big game and you think you're going to lose, you have no chance of winning. I'm not saying if you're super confident you're going to win, but your chances of winning are way improved. And I think far more startups fail by giving up than they do by anything else, because it gets too hard. I mean, this stuff is just, it's ridiculously hard to kind of continue to go forward, and, you know, you're slugging it through the mud. You know, everyone wants to do like open field running, and it's like, it's not like that most of the time. I mean, you're just slugging it out.
Oh yeah. Well, it's over glamorized, right? I mean, everybody's an entrepreneur.
Sure.
All of these things. It was and the stats don't lie, right? Like 90% of startups fail, 75% of venture-backed startups fail. So these have been filtered, and these are the good ones, right? 75% of them fail. I think it was
Yeah.
Elon Musk. The entrepreneurship is like sitting alone, staring in the dark, staring off into the abyss, eating glass. And like that's the reality. It's like it sucks at times. Coming from somebody that started a business and failed before, like it happens. And you know, I believed in myself. I had resources and time and all of the confidence in the world, but it happens. It happens to the best of us. So yeah. So we're bumping up against the time, and I want to be aware of that. But where can people find out more about you, your book, your company? Where do you want to send listeners?
Sure. I mean, you can go to groguru.com. That's our company, GroGuru. That's, you know, my main focus right now. I'm on, like you said, I'm on LinkedIn. My name's Patrick Henry. I'm not the guy that, you know, was involved in the early revolutionary stuff of the country, but the other Patrick Henry. So you can find me there. I'm on Twitter at Quest Fusion, which is my consulting and strategic advisory business. That's kind of my personal blog is on Medium, but it's also on Quest Fusion. Medium is more up to date because I just throw everything up there now because there's a lot more eyeballs on that platform. And you know, that's probably the best ways to get a hold of me. Drop me a direct message in my LinkedIn, or, you know, if you're interested in strategic irrigation management, you're a farmer, then, you know, contact us through GroGuru.
Sounds great.
Oh, my book is on Amazon, so that's like the easiest thing to do. So it's just look for Plan, Commit, Win. It's called Plan, Commit, Win, and I think it's still very relevant. The environment, like I said, venture capitalists kind of moved downstream, so it's still relevant, but you know, most venture capitalists are doing later stage deals. So in the startup environment, you need to be more creative, and there's this funding gap, which has been filled by angel investors and super angels. And I think that why I'm really optimistic about equity crowdfunding and even, you know, Regulation A+ is that it's helping to potentially fill that funding gap. It's kind of coming of age. It's still in that adolescent phase, but it's starting to come of age where it can be a real good source of capital for companies. But you got to do it the right way. If you do it the wrong way, it can really kill you in your next financing round. So it's like, you know, have some intelligence about it, which is, you know, read, learn, but also have good mentors.
Awesome. Yeah. Well, I'll link all of those things in the show notes, and it's
Cool.
certainly crowdfunding is growing, and it's significant funding at times, right? So it's becoming a real good alternative.
Yeah, and like Reg CF, you know, the cap is $1,070,000, but we were able to raise additional money in a Reg D on Wefunder. So our accredited investors, we pushed them into the Reg D. That's how we were able to raise $2 million. Is we had kind of the Reg CF and the Reg D going simultaneously. Right. So it's it was a great experience, you know, and it really is a game changer for GroGuru. And, you know, like you said, you know, made me more optimistic about this as being something that can be really important and relevant going forward from the startup community standpoint.
Well, coming from you, that means a lot with all of your experience crowdfunding. So Patrick, really appreciate you spending all the time today. I'll make sure and link up all of these things in the show notes, and really, really appreciate you taking the time.
Thank you. Really appreciate the exposure and great conversation, and good luck with your deal as well. You know, these things aren't easy.
They aren't indeed.
Stay tough, fight the good fight.
Eat that glass. Sounds great, Patrick. Thank you. There you have it. Thank you for listening. I really appreciate your support. Show notes, transcript, links, and more can be found on our website at altassetallocation.com. If you'd be so kind, please share this with anyone you think might be interested or get some value from this conversation. If you have any questions or comments, please reach out. I'm always happy to hear them. Lastly, if you're on YouTube, please like the video or subscribe to the channel. If you're listening to the audio version of this, please subscribe to the podcast and or leave a review. This really helps more people find the podcast, and I really appreciate it. Thanks again, and hope you have a fantastic day. Happy investing.